In today's episode of the Morales Group Show, we're going to be talking about how to invest in mobile home parks. To help us with that, we got Kevin Bupp with Sunrise Capital Investors. We're going to be talking about what are the best locations to invest in mobile home parks. We're going to talk about once you find a mobile home park, how do you underwrite them? How do you finance them, meaning loan to value? How do you manage them? And then we're going to talk about whether it makes more sense to own the mobile homes itself, or to lease the land. And we'll also even get into some of the tax advantages like depreciation. This is an episode you want to watch until the end. Welcome to the show, Kevin. How are you?
I'm doing great, Jose. Thanks for having me here.
I love it, man. Thank you so much for taking the time.
Yeah. Let's talk mobile homes.
Let's do it. So let's jump right into it. Why mobile homes versus like an apartment complex or like a self-storage facility or a triple net lease?
Yeah, it's a great question, and I don't know if one's better than the other. I like to think that mobile home parks are one of the best investments. But with that being said, just in all honesty, I think you can make money in all those asset classes that you just mentioned. You can make a lot. That there's many folks that have made billions of dollars in each one of those respective asset classes, amongst many of the others. So I truly believe that there's a million and one different ways to make money in real estate. And I just we and I've owned a lot of different types of assets over the years. I've owned a large portfolio of single family homes way back when. Started buying apartment complexes, owned apartment complexes. So I understand the traditional multifamily business. I've owned retail, industrial. I've owned self-storage. I've owned medical. I owned a lot of different things. And I just happened to kind of fall into mobile home parks, I guess about 13 years ago. And just, again, just like all those other asset classes, didn't know much about them when I, got into it. Bought one after talking to somebody that owned a few, and kind of fell in love with the business model, and saw that there was a bigger opportunity to scale a portfolio out of it. So like that first one we bought back in 2011, and owned it literally up until about 2 years ago, and have been buying them ever since. So we currently own in 14 different states. Have owned in as many as 18 states, and Southeast, Northeast, and Midwest. And we love the business. So again, I don't know if I'm not gonna make the argument that it's better than every other asset class or better than multifamily. It's unique, and it's I guess the one thing I think that makes it so unique is it truly is the best option for affordable housing. It's by far, you pick any market in the country, anywhere we own anything, anywhere you own anything, I can guarantee that a mobile home, not in a bad part of town, in a normal, good part of town with good school districts, is going to be less expensive than that of maybe the comparable apartment complex. And I guess if it's a B class apartment complex to what you might rent for that mobile home and that same quality of community, you're going to typically pay less, sometimes 20-25% less, and probably actually have a little more space, not have neighbors above you, below you, on either side of you, right? Like have your own parking space. And so I do think it's truly one of the best affordable options that's available in the U.S. here.
Yeah, which would make it like more recession proof, more than likely,
That's right.
just because if things go down, usually people try to downsize, and this would be probably the most affordable option for them.
If they can't afford that, like and I don't even like to make a joke out of, but it truly is the case. I mean, if you can't afford, to live in, so for example, like of all the various mobile home parks we have, most of the residents own that home. They own it outright. They've owned it for years, and so their only monthly bill is the lot rent that they're paying. And so on the low end of our portfolio, I think the lowest park we have is probably like $360 a month. On the high end, it's probably $750. But so call it somewhere in the middle is $500 a month. There is absolutely, even in some of the worst parts of the U.S., the worst cities, there's still nowhere you can truly live for that $500 a month. And on top of that, let's say that individual runs into some hard times. They lost their job, and like $500 a month, they got to come up with it, or else they're out in the street, truly, because there's nowhere else to go. There's a lot of things you could just about anybody, I don't care who you are, what your skill set is, you can find a way to make $500 in a 30-day span of time. You can go buy a case of water from CVS and sell them for $1 a piece on the corner, right? And like you could find a way to make $500. And if you can't, there's no other option for you. And so like I truly, and it's not that, again, I don't feel that they're the lowest quality option at all. In fact, some of these mobile homes are so nice nowadays.
Oh yeah.
I mean, like they're built with the same materials as a traditional stick built home. So I just think it's one of the best affordable housing options in the country, hands down.
I agree with you 100% on that. Like, I tell clients, like, if I had a choice between living in a condominium complex where common walls, people
Hmm.
above me, people below me, having to walk out to go get my car in the parking lot versus having it in my driveway, I tell people that I would probably rather pick a mobile home. I think people have a negative stereotype in some cases about mobile home parks. They think like country, they think just things that they see in videos.
Drug, sex,
But
and rock and roll, I like to say. Yeah, like
right.
all the bad stuff, right? But that's not the case. That is far from it.
That's so funny. I wanted to kind of, you said you bought your first mobile home park in 2011. If somebody is considering buying their first mobile home park, like, can you walk us through that deal? Like, what did that, how many units was it? What did you purchase it for? How did you finance it? Just to kind of give the consumer some perspective.
Yeah, and I just want to I want to put a disclaimer here saying that back in 2011, real estate in general is a very different landscape, right? There was lots of distress. Prices were much lower than what they are today, and so and not that you can't replicate this exact deal again and go find it somewhere else in the country, but it'd probably be very difficult to do at the price points I'm going to share with you. So I want to throw that out there. Um, Yeah, so this is 2011, so the world was still, I mean, it wasn't even on
Falling
an
apart.
upward swing from recovery. Like, it was still in shambles from '08. At least most of the country was. Atlanta, this is in Atlanta. Atlanta was in rough shape. They had overbuilt a lot in Atlanta. Just and so anyway, we bought this mobile home park. It was an REO. It was had 34 units. 34 homes in it as well. All 34 homes were coming with the deal, so they are owned by the community, which isn't typically part of our business model, but in this one, that's how it was. Or the receivership took over the deal. For whatever reason, they vacated all the residents that were living there. I have no idea why. I wasn't privy to why, but when we went to look at it, there was one actual, or the receivership took over the deal. For whatever reason, they vacated all the residents that were living there. I have no idea why. I wasn't privy to why, but when we went to look at it, there was one actual home that was occupied. They were squatters, but all the other homes had been purposely vacated. And so, when that happens, you got vacant units. They were vandalized. People stole the AC units from them over time, and it just it needed a lot of work. But we ended up paying $220,000 for it. We ended up putting like another $350,000 into the renovations of the homes. Took us, just shy of a year to fully renovate and stabilize. We had multiple renovation crews in there working, renovating the homes. Had it all leased up, in less than a year, and did a full cash out refinance in about a year and a half. Got all of our original capital back out of the deal, paid off our private lender, and literally held it to about 2 years ago, when we finally sold it. But I guess to give you some of the numbers, when we were all into it for roughly like 550K. Um, I guess when we refinanced it back then, I think it appraised for about 900,000 when we went and
Wow.
got that first loan on it. Um, and then when we sold it, I'm trying to think we sold it 2 years ago or 2.5 years ago. I think we sold it for 1.4 is what we ended up selling it for. But in the interim, it cash flowed like crazy. We got all of our money back out of it, and like we truly would net. I had one other partner in the deal, and we would, after all expenses, after debt service, everything, we would net about $110,000 a year, split, so $55,000 a piece from this little small park, this little 34 space park. So economically, it made a lot of sense. it was
Hmm.
a, it was a really good deal. Again, I think it'd be very difficult to ever replicate that again in Atlanta today. But but also that was a property that probably scared a lot of other people away. I mean, it was rough. It took a lot of heavy lifting. It took a long time to really change the reputation that it had
Yeah.
built. I mean, again, this was now the place where all the construction workers would come dump their debris and their sofas and all their materials after they're done with the job. So like every day we had new crap in there that we had to clean out because people just kept dumping in there, and just people squatting and doing drugs and breaking into units, stealing AC units, and just everything you can imagine, until we could finally turn it around and change the reputation. So, but that was the first
Got it.
one. That was that gave us a little bit of a practice, and then we just went on to
Bigger
do
ones.
about 40 more. Yeah, so I think we've done about 45 deals so far over the years, and it's been a fun run.
I
And
love
a
it.
lot bigger ones.
Um,
Yeah. So like most of the stuff we do today, that was probably one of the smaller parks we've ever bought. But I'd say the average size what we buy today, is about 150 spaces. We have our largest single community. It's a beast. It's like 4 times the average of our other stuff, but it's 738 spaces, right? So it's like a small city. Um, but there's a little bit more efficiencies with the larger assets. Just a little bit more bang for your buck as far as the amount of work and reward that you get back out of that work that you put into it. And then also a little bit more desirable financing terms available in larger assets. And then even on the flip side, when you go to exit out of something, if that's your plan, much more desirable buyers that will pay more premiums on the back end for larger things, for larger assets. So we tend to focus on larger deals nowadays.
Got it. What do you typically look? Are there certain markets that are better for mobile home parks? Do you guys look for like a minimum population size? Do you guys look for markets that are growing? What do you guys typically
Yeah.
look for?
Yeah. Definitely population is important. I mean, I'd say at minimum it's got to have 100,000 people. I mean, the bigger the better, right? I'd say that the areas that we don't go, we tend to stay away from states that aren't landlord friendly, that have laws that are difficult when it comes to evicting
California.
tenants and things like that. California is rough. Rent control states. We did own in New York for a period of time, and it's got statewide rent control now, which was it just inhibited our business plan, and so we don't own there anymore. So we stay away from anything that is remotely, with the exception that we still own in Maryland today, and it happens to treat us really well, and we're kind of in the red part of Maryland, and so like it's been fine. But Maryland as a whole is kind of, it's blue because of Baltimore, but mostly red states, landlord friendly states. But the more important factor that we look at is, since we're in affordable housing, we want to be in a market that has a very big challenge with affordable housing. And so like median home prices is the better metric to probably use, and median rents. Like what's the median home price? And anything over $250,000 is a great market for us. Obviously the population has to be there, but like, if median home prices are 250 plus, hands down, we can kill it in that marketplace. Cause I know that that the average individual that works, makes $15 an hour, both husband and wife work, they're not buying it. They can't afford that $250,000-$300,000 house. It's not happening, right? And so they sure as heck can afford an $80,000 house inside one of our communities that's brand new and really nice and has a home warranty and all that, right? Same with like, we look at median rents as well. We'll look at like, if the median rents in a given marketplace for a 3-bedroom is greater than $1,500-$1,600, hands down, we're going to kill it in that marketplace. And so the higher the better, right? And so now the options are, if they're renting, paying $2,000+ for probably an older vintage 3-bedroom, two or 3-bedroom apartment, or paying $1,300 or $1,400 for a newer, probably nicer, probably safer mobile home in the same marketplace. And so affordable housing is what we provide. I want to know that there's a massive demand for it in that marketplace, and high price markets just they prove that time and time again. Like that's what's needed.
When you say something like semi brand new, like I've looked into manufactured housing in California, and it almost seems like the prices are a lot higher. I don't know if it's different in other states, but when you say like something almost brand new for like $80,000, what does that typically get you? Is that like a 14, like a double wide, a single wide? What does that look like?
Yeah, that'd be, and so like now they come in different grades as well. I mean, like just like you can get a stick built home like builder grade, mid tier, then luxury, right? Like all
Mhm.
different quality materials and quality of the build. And so like your builder grade mobile home, it would be a single wide, and also the area that's located in has relevance as well. Like if it's in Florida, you have to like deal with wind codes, and so like if you're near a coast, like you got to have hurricane impact windows. That's going to increase the price of the same home, the same
Mhm.
floor plan, right?
Mhm.
It might be like another 20% higher. But generally speaking, in any of the just call it Georgia, the Carolinas, anywhere in the Northeast or even in the Midwest states that we own in, Indiana, Ohio, all that, like they're all pretty standardized as far as like what we can buy and what we can provide for a particular price point to new buyers. So we can get a 3-bedroom, 2-bath, single wide, 16 by 76 home. So it's like 1,200 plus, about 12, I think 12, 1,200 plus square feet, somewhere right around there, 3-bedroom, 2-bath. and we can get them into that home for about $75,000 to $80,000, and that's close to our price. Like we don't mark up the actual sales price much at all. Like we don't. That's not like really where we make money in our business. We want to get someone in there that owns the home and pays the lot rent. Like we really, there's not enough
That's
of a
the
margin
business
for us
model.
to make, and we could, like, if you went to if you went to a mobile home dealer yourself, like we're licensed dealers, so we get wholesale pricing from manufacturers. So that same home that we might be selling in the community for 80, if you were just a retail buyer going in, you'd probably pay 100 grand for it, right? And so like we try to just pass the savings on and then really make our money on the lot rent side of things. So
Got
it's
it.
I mean, it's a good bit of home that you get. I mean, when you think about it, I mean, you're talking like, $65 a foot, $70 a foot, for a brand new home that's got most of them come with like a 2-year warranty. The ACs and the roofs have 10-year warranties on them. So not much to have to really worry about for, the first 10 years of ownership. So it's a good
Do,
option.
do the do these sell like in a secondary market, or are there certain like, let's say I just bought a mobile home park, and let's say that there's 20 empty lot spaces. What
Mhm.
would be the best way for me to fill those empty 20 lot spaces?
Yeah, I mean, lots of advertising ways that work. I mean, Facebook Marketplace is probably hands down the best place as far as getting traction on home sales. Craigslist still works in some areas, not many. There's still parts of the country that still use it. um, some states that we own in, like Maryland, for example. And I don't know why this is, but some states that we own in Maryland, when we used to own in New York, I think it's pretty common in like Arizona and California. And it's not a requirement, but it seems that a lot of mobile home transactions transact on the MLS,
Mhm.
where like they're actually listed there's brokers and agents that specialize Florida's the same way. Like I don't think they're not licensed real estate agents. There's a different classification. Like they're like
Yeah.
licensed RV dealers or whatever, but there's brokerages that's all they do, and that's their specialty, and they get them on the MLS, and that's how that's how they're typically sold. They're not sold on Facebook or Craigslist. So it just depends, but every market's a little different than us. But basically the same way that that one would sell or rent a home or list an apartment. Um, we do put it on all the other that we put it on Zillow. We put it like there's a couple different other areas that we kind of syndicate our listings to, but predominantly most of our new buyers come from Facebook.
No, what I was referring more or less to,
Oh, okay.
like let's say there was an empty lot right there.
Mhm.
Do you guys allow the buyer to bring in their own mobile
I
home,
gotcha.
or would I, as
Understood.
the owner, provide it? And if so, where can I buy these mobile homes to be able to
Understood.
sell them to these people?
Understood. Okay, yeah. Now I understand the question. So, I mean, in a perfect world, if you got vacant lots, in a perfect world, you just have people. Your community is so nice; they want to move their own mobile homes in there, right? Like it doesn't
Yeah,
cost you much money to do that. You have to have the lot prep for them, but like they're
yeah.
going to incur the majority of the cost, right? That's in a perfect world. That happens. It doesn't happen all that often, but that surely happens. We have a few communities where we get organic move-ins. That's what we call them. Organic move-ins, where people like literally they just like the community so much they want. There's an empty lot, they want it. But most of the time, that's not the case. Just because a lot of folks that if they own a mobile home somewhere else, they don't even have the means probably to move it. They're pretty expensive to move and reset up. You're talking 10 grand to if it's a local move and to get it reset. And so like 10 grand cash, right? You're not financing that amount. And so the average person living in a mobile home probably doesn't have 10 grand laying around to move it to another community. So what typically has to occur is you or I, the owner of that mobile home park, we become a licensed dealer in that respective state. That allows us to go buy from any of the major manufacturers. I mean, Clayton's a big one, Cavco's a big one, Champion. Those are like the big three, the big dogs. They have manufacturing plants all across the country. When we're a licensed dealer, we can go buy from them at a wholesale price. And basically there's financing options as well for mobile home park owners, where we can basically go buy. We got 10 homes being delivered to one of our communities over the next couple of days. Literally 10 brand new homes coming in. They'll finance us, to have these homes in there, give us a period of time to get them set up and sold. And that's the best way to do it. So we bring the homes in, we identify the floor plans and the layouts that we feel are best suited for that marketplace, the demographic that we're serving, right? Like if it's mostly like a senior demographic, seniors tend to like double wides, and they really don't like more than 2 bedroom, 2 bath. They don't need a third bedroom a lot of time, right? And they want a front porch because they want to sit out and people watch, right? Whereas maybe if it's a young family, that's got some kids and it's their first house, like they want the most bedrooms, like they want the most like bedrooms per square foot. And so like same floor plan, but give me the 4 bedroom. If you can squeeze a fifth bedroom in there, like that's going to go a lot better if it's like a family type area. They want more bedroom
Hmm.
space. So it's just, you identify what you feel the need is, and you go buy it from the manufacturers. And a lot of times, these homes we just ordered, I think they took about 7 weeks to make, so it's quick.
Hmm.
From the time we put the order in to the time they're rolling in the community, about 7 weeks. And it takes us about another 3 weeks to a month at most to
To get
to
them
get them
sold.
set up, get all the utilities. Well, no, to actually get them ready for sale, get utilities connected, get inspections passed, and then literally have it ready to actually put on the market and start showing it. Because you still have to hook up utility lines, get permits
Yeah.
for all that, get inspections passed. Anyways, it's there's a process to it, but it's still fairly, in the grand scheme of things, like literally in 3.5 months at most, you can have a brand new home ready to roll, and sometimes a lot faster than that.
How do you like, are there any rules of thumb? Like, so it was funny. I used to go to real estate events and somebody would be like, I have a great rental opportunity for you. I'm like, okay, great. Tell me about it. They're like, you could buy it for $1 million and rent it for $5,000 a month. I'm like, that's not a great rental
That's not a good
opportunity.
deal.
It doesn't meet the 1% rule. And some people, because they didn't know the 1% rule, it would just take them forever to underwrite something. I can make a decision like very fast. Are there any rules of thumb for underwriting like mobile home parks that would allow me to just say, okay, like that, or is it the same thing as 1%, or what would you guys be looking at?
Well, I mean, I think there's other factors involved. I mean, we look at a park itself. I mean, we have certain metrics that we want to hit internally for ourselves and our investors, right? And a lot of that's going to be dependent on, what the going in cap rate is. Is there an opportunity for us to increase revenues by pulling certain levers? Like maybe rents are really low, we're going to raise rents, or maybe we're going to infill some vacant lots with brand new homes and sell them, or maybe we're going to build back for some utilities and kind of drop that expense to the bottom line. Or what type of debt can I get today? Like what's the options out there for financing? Like, and there's a wide range there as well. Like Fannie and Freddie are in this space, and they probably have the most desirable financing, but like they're really particular about what type of communities they're going to lend on, right? And so, like, anyway, for us, it's like we look at the business model as a whole. And I'm trying to. This is not a simple answer, and I'll try to make it as simple as possible. Or at least tell you like how I look at it. Like I want to be able to hit in a particular part. I want to know that we can achieve with whatever plan that community has. Every plan's a little different. I want to be able to achieve a 16 to 18% return in a 5 year span of time. And I also want to be, like, our cost of capital to our retail investors is roughly about 9% at this point in time. And so I want to know that, within 24 months, that with whatever debt I put in place, whatever the business plan is, that I'm at least breaking even on a cash on cash return on a monthly basis, so that I can at least pay for the cost of capital, right? Still upside there after that, but I want to, get to a stabilized break even point within the first 2 years. A lot of times we get there sooner, but that's kind of like worst case scenario. Um, so there's not really the 1.5% rule. For us, it's like kind of overall returns. And what does that look like based on the business plan, based on the financing, based on what we're paying for the park, based on how heavy of a lift it's going to be. Um, and where there's higher risk, typically we want to see higher reward as well. If we would take over that community that we bought originally, like that Atlanta park completely vacant, like that's a
It's
massive
highest
risk,
risk.
right?
Yeah.
Yeah, right. And so I would want a much higher reward than what I just outlined to you, as far as like once we get to that stabilization mark, cash on cash, and also, what does IRR look like on the back end when we go to exit out of it. So it probably would need to be double of what I typically outlines our typical deal, because like we don't do deals like that often. Like, in fact, I can't remember last time we did a deal where it's completely vacant, no income whatsoever. It's just that was an anomaly.
Yeah,
But
the risk to reward ratio has to correlate. So maybe we can work it a different ways. Like, what is the owner responsible in a mobile home park? Like, meaning, like, are they responsible
yeah.
for utilities? Um,
hmm
are they responsible for streets? Are they responsible for?
As far as the upkeep, like yeah,
Yeah.
typically like we own the water sewer lines, we own the streets, mostly, not in all communities, but most of the time that's common. Like we're responsible for maintaining the streets, maintaining the water lines, sewer lines, common grounds. If there's a clubhouse, if there's any type of amenities, if there's street lights, most of the time that trees throughout the community, trees and lots, like any of that is our responsibility. Um, as far as the resident's responsibility, normally it's kind of like where the riser for the water line comes out of the ground and connects to the house. Same thing with the sewer. Like past that point is
That's
the resident's responsibility. Anything inside that home's their responsibility. As far as like who mows the grass and all that, like it all depends. We have some communities where we mow everything because it creates consistency. And we
yeah.
have other communities where maybe we took it over and it was the tenant's responsibility. That's how it's been run, and we just keep it that way. So they mow their own grass, and we'll still take care of trees and things like that, but they'll mow their own grass. Um, I don't know if that answered your question or not, but
Yeah.
is that what you're seeking?
Yeah, let me ask it a different, or yeah, that's what I was seeking in that question. But
Okay.
so, like, let's say a rule of thumb, like if I'm buying an apartment complex, obviously it depends on the year bill. It depends
Mm-hmm.
on deferred maintenance or no deferred maintenance. But I typically underwrite apartment buildings at like a 40% to 45% expense ratio. Like,
Mm-hmm.
are there are since you're not responsible for toilets, you're not responsible for um like anything inside of the home. What would be like an expense ratio for a mobile home park if I'm just like looking at
Yeah.
like gross rent multiplied
Yep.
by an
I
expense
got
for
you.
or yeah.
I would say on the low end, and so this would be a community where we own zero homes. This would also, and this is actually an example of a community we own today. We own zero homes in it. The streets happen to be managed and owned by the city, and so they maintain potholes and all that stuff. We don't have to put capex budgets together for the streets on a yearly basis, which is normally a high line item. The water and sewer is actually direct billed by the municipality, and so like literally they get the bill directly from the water provider and the sewer provider. Normally, we would get a master bill and we would bill them back for the allocated use, which there's always some loss there. You never recapture 100%. And so that's like the perfect, like literally about as easy as it possibly gets. And then also another consideration is there, what are the property taxes? Some markets have just really high property taxes that might skew that expense number, right? But in this
Mhm.
community, it's about a 28% expense ratio, which is about the lowest I've ever seen it. It's a low tax market, low property tax market. Utilities are directly billed. We don't own any homes. Streets are maintained by the city, and so it's I think that one's about 28%. Now on the flip side of that, you've got situations where there's older infrastructure. You got water leaks that tend to basically that responsibility falls on the owner of the park, right? And so there's loss there as far as water expense is concerned.
Uh-huh.
um, you know you're not recapturing as much water and sewer because you're billing it back to the tenant. So while your bill's 100,000, you might only be recapturing 85%, which is a pretty good rule of thumb, right? And so you're still losing out about
Mhm.
$15,000 a year. You also might have some private utilities. You might have septics. You might have a wastewater treatment plant, which is like a self-enclosed sewer treatment facility, and we own a number of them. Where literally you're basically a miniature version of what the municipalities use to service the
Mhm.
sewage in the park. You have well systems. All those private utility systems are very expensive to operate. Like wells, we have professional operators that come in some markets daily and test and submit to the state. Those are really high expense line items, as is the wastewater treatment plant, because there's a professional operator that has to be licensed that manages it and maintains it. And so like it could be as high as 50% on the other end of the spectrum. So 30, I'd say 30 on the low end, 50 on the high
50 on the
end.
high end.
And then once you actually start throwing, if you own a bunch of the homes as well and they're rentals, and you run a park like that where you're literally running a lot of rentals and you're actually handling repairs and maintenance on the homes, turnovers, down units, for a couple of months when you're turning it, you might see an even higher expense. Like you're going to might as well add another 10% to that,
To
and
the
push it up.
expense ratio.
It'd be the equivalent, because like that becomes the equivalent of like if you have a bunch of rental units, normally those parks are, if they've been rental units for a long time, they're older homes, they've beat up really bad. It's kind of like a C minus class apartment complex. They've just been used and abused. Things have been band-aided together over the years, right? And so every time you go and
Mhm.
do a rehab, it's an expensive one. It's not just a quick, $900 turn. It's you're dropping thousands of dollars in it, right? And so in those instances, like I've seen some C class apartment complexes that they're running 60%, maybe 65% expense ratios on the high end.
Yeah. Who
So it's a wide
typically owns
range.
these who typically owns these mobile home parks that you guys are buying from? Are these like institutions or these like more mom and pop type of people?
If you'd asked me that question 5 years ago, I would have said it would have been 99% mom and pop that we were buying from. The
Mhm.
market or the industry has been consolidated somewhat over the years, not entirely, but there's still a lot of mom and pops in it. But there's a lot of other institutions, or not even institutions, just more professional operators, right? Like investment groups like us. Um, and so it's kind of a wide array. I would say mom and pops is still our bread and butter because normally there's still a good bit of meat in the bone. They haven't necessarily, they've owned it for 30, 40 years. They haven't pulled all the levers to really increase value over time.
Mhm.
But then on top, or I guess on the flip side, like there's other groups like us that might get into the space thinking that it's just super easy and it's just like literally passive and there's not much to it. And then they realize 3 years down the road that they haven't been able to execute the business plan. It hasn't gone as planned. Like they're not making as much money as what they pro forma out, and they get out of the space. We just bought a park 2 weeks ago from a group just like that. They're really good in the multifamily. They're going to try their hand in manufactured housing, and they bought about 9 communities, and now they're on their way to selling their last one right now, and are exiting out because it didn't go as intended. And so, um, it's a wide array of who we're buying from. We haven't bought anything from institutions, but there's surely a lot of institutional owners in the space now.
Mhm.
But yeah, mom and pops are by far the best.
The
At
best
least
people in the
where we see the best opportunity.
Oh,
Just
yeah.
they haven't put capital back into it a lot of times. They haven't kept up with market rents. They haven't even we just bought a community last year where, man, their water bill was like their water and sewer bill was about 4 times what it should be based on the number of units in this park. And I like went back, historicals for years, and it literally had been that like they had literally just been paying this massive bill. And I'm like, at
Why?
what point in time did this like just like because the water rates in that area were not that high. It wasn't like some like weird market where the water rates were 4 times the amount. And they're like, well, I mean, we noticed over the years where it just kind of kept creeping up. We just assumed it was they kept jacking the prices on us. I'm like, no, you have
No.
leaks everywhere underground. Like we literally went in there and we spent about $25,000 on leak detection and fixing various states of water or various areas of the water lines, um and we all that savings went to our bottom line. I mean, we didn't do it till after we fixed it, but like ultimately, like that was impacting their expenses, right? I mean, it was inflating them a great deal. So that was an easy lever to pull for us. Go in and just fix the problems that they hadn't addressed for many years.
Yeah. And not only that, but you're able to increase the value of the building now because you've
Well,
reduced the
right.
expenses significantly.
Well, it reduces the expenses, which increases the NOI, which ultimately
Yeah.
increases the value of the
The
property. So
value.
right, like all that goes to the bottom line, which just inflates the value a great deal. I mean, like on that particular deal, I think conservatively speaking, it probably added like $1.5 million worth of value to the property. So I mean, it was real. It
100%.
was a real number.
Yeah. Yeah, that was the very first thing that I did when I bought my apartment building. The fix leaks. I think I took a water bill from like $5,000 a month to like $2,500 a month,
Yeah,
and that was like the very, very first thing that we did. What about rent control in California? I hear that there are certain parks that have rent control.
yeah.
In the states that you guys are investing, could somebody go in there to somebody that's paying $500 a month and jack it up to $1,000? Is that does that happen? Or is there any sort of protection to the person that has their home there?
I mean, it surely could happen if there's truly no rent control laws in that respective state. And surely there's groups that have done maybe that's an extreme case, but there's definitely some groups that have made the news over the years. I mean, for doing just that. But I mean, if the market, if I know of a deal right now that's about to happen, and not through us, but the market is probably about $1,200 a month. It's actually out on the West Coast. It's about $1,200 a month, and it's a really nice community. It's a 5-star. It's a really gorgeous community. 100% occupied. Really nice homes in it. I mean, it's a high end community. It's not affordable housing. I mean, I guess
Mhm.
it could be for those that live there, but
Yeah.
it's these mobile homes sell for 250 grand, right? Like they're expensive. Um, and the lot rents right now, I think it's like on average like 750 a month. Surely that next buyer could go in and probably push it all the way to 1,200, which is where it should be anyway. It's just that the owners haven't kept up with it over the years. Um, they probably wouldn't even lose anybody because there's nowhere else they can go for cheaper, right? Like they're all the other parks in the area at that price now. But they'd probably get a lot of bad press, is my guess. They'd probably end up on the news, and they'd have advocacy groups knocking down their door. And so I guess that's the downside. And on top of that, I don't think I don't think it's the way to conduct business. I feel like that's it's just not fair to the residents to take that extreme approach. I think there are ways to get to market over a few years and still have it make economic sense for the owner or the investor buying it, but also, give value back to the residents as well, make improvements over time, put amenities in, upgrade amenities, things like that, and kind of justify
Mhm.
the increase rather than just going and right out of the gate and smacking them with a 40, 50, 60% increase, which again, it happens, but
Yeah.
there's only a few states that have the mechanisms in place that prohibit that. California, I think California's not statewide. I think it's jurisdiction
Park
by
wise.
jurisdiction.
Okay.
But I think it's county by county or even municipality by municipality. I know it's not across the entire state. Oregon and New York are, I believe, the only two states that truly have statewide rent control. Oregon was the first that did it a couple years back, and it's not all that egregious. It's like 7% plus CPI is what you can
It's not
increase on
bad.
a maximum. Yeah, so call it 10%, right? New York is by far the most restrictive. We actually owned there when they passed this, and we've sold out since because it's so prohibitive. It's 3% normally. You can possibly get 6% if you can justify the other 3% with detailed capex plans, quotes, and ultimately what you've spent on the improvements, road, this, that, and the other. Like, has nothing to do with just general inflation at all. So you got to spend money to get that other 3%, but you're capped at 3% on a regular basis, which you know many would argue that inflation's still higher than 3%, right? So
Yeah.
you're not really
100%.
keeping up with the world that's turning around you.
Yeah. Do you have any preference between senior parks and family parks?
No, I mean senior parks. For all the reasons that most probably think of, when they think of a senior park, like a little bit more of a stable income, right? You got to get a lot of folks
Mhm.
that are on fixed incomes, and so and just I feel like the older generation is just a different generation than that of what's growing up now. And I kind of, it's funny, I age myself when I talk like that, but like it's just different, right? Like I just feel like there's our parents and our grandparents just thought about paying their bills and thought about those priorities a little different than like the younger generations now of like what's
Hey,
important.
hey, hey,
What should I
hey,
pay
hey, hey!
first? I'm
Knock
not
it
that. Hey,
off!
I'm
Come
young
on,
too. I'm
I'm
not
just
that
kidding.
old, but you know what I mean. So
I'm
like,
just kidding.
and so with that being said, there's more stability across the board on senior communities, but on the flip side of that, they're a little bit more of a needy resident. We own both, and we've owned both, right? And
Yeah.
so it's a little bit more of a needy resident base, and so I mean, it can be overwhelming for community managers because you got a bunch of folks that literally are around all day long that have
Hmm.
nothing to do but complain or just be a burden sometimes. So family parks, those folks are working. They're hopefully at a job each day. Um, but then on top of that, you got lots of kids in communities. Sometimes that can be a problem. That can create challenges. You got 50, 60 kids running around. A percentage of those kids are going to have the wrong idea, do things they shouldn't do, hang out at the playground at point at night when they should be hanging out there. And so just they have their own unique challenges with each. But generally speaking, I think as with any type of real estate, if you do a good job of like qualifying your resident base, you know what I mean? Like putting parameters in place as far as like background checks and credit scores and checking employment and all that kind of stuff. I am of the mind that the majority of this world are good people, right? That only want to do good things and want to treat each other fairly. So with that, outside of a few different anomalies of residents, like we have it's a good batch of people both on the all ages communities as well as the 55 plus.
Yeah. What about price per lot? Do you guys ever look at that as a metric, like price per
It's
unit
not.
or price per lot?
Back when I got into the business, like that's how like some of the old school guys, that's how they valued it. Just because it wasn't it lacks sophistication, and that's literally how they looked at values. Like they'd be like, well, this whole park traded for 40,000 a lot, and this one, and so that's what mine's worth. And the other park could have been $500 lot rents a month, and this, the one he's referencing that he owns could be 250, right? And so like now I think sophistication has entered the space to where it's viewed just like it is multifamily now, to where price per space has some relevance, but really it's what the driving factor is like more of the income per space than
That it
anything
brings.
else.
Yeah.
Yeah, yeah.
What about the financing? How does the financing typically work for these? Like, is it like typical, like 70%, 30% down, 20% down?
Yeah, I mean a lot of it's got limitations now based on debt service coverage ratio, right? And so like those are a lot of the limiting factors nowadays. I think more than it is from an LTV standpoint. Um, and so I would say on average 65-70% is probably where you should be ending up or where you can end up. Not that you might not be able to put, if you just get a killer deal on something,
Mhm.
and you got a local bank you've done a lot of business with, you might be able to get them to push the envelope a little bit, especially if you got a really solid debt coverage ratio, even at like a 75% loan to value, right? Um, and then there's outside of like regular banks, there's Fannie and Freddie are both very aggressive in the space. They're pretty particular about the types of parks that they'll lend on. They want nicer quality parks, bigger communities. Like they used to have a small loan balance program. I don't know if they do anymore. I think really they're looking for like $5 million or higher loan amounts,
Plus.
preferably 10 million. Like Freddie's really like 10 plus. I mean, they'll do other stuff, but like they're kind of looking for bigger loans. There's CMBS loans in the space, CMBS lenders that love the space, and so just a lot of it depends on like kind of the business plan. Like what's your intent with this park? Is it going to be a quick flip? Is it going to be a long-term hold? If it's a long-term hold, you're probably more inclined to go with like a Fannie or Freddie loan. They've got better interest rates, longer amortization terms. They'll give you longer interest-only periods, but they're also, they're somewhat restrictive in that, like, they've got pretty significant prepayment or defeasance penalties associated with them if you try to get out of them early. So if you get into one of those and you realize that I don't want to own this park anymore after 5 years, you could sell it and have someone come assume that loan. But if it's not in a good environment for where they would want to step into your loan terms, you might have a fairly significant prepayment on your hands to get out of the loan. So just a lot of considerations depending on the park, your business plan, and what your long-term strategy is.
How much lower are Fannie and Freddie in terms of rates than market? Like, is it like 1%, 2%
I
typically?
wish I wish there was a standard metrics I could give you, but I would say probably on average, if you just wanted to like compare it like your local
Community
bank,
bank, yeah.
yeah, community bank, um, probably every bit of 100 basis points, if not like 125,
Wow. So
even,
like for
yeah, and
1%
maybe
to
even sometimes
1.2.
150. Like yeah,
Wow,
yeah, but definitely 100, over 100 for sure.
that's awesome. Good. What about like tax benefits? Like, so I read a book. I don't think I've read your book yet. I see it in the background right there, which we'll jump right into it. But I read a book and they talked about like how the tax benefits and the depreciation is higher on mobile home parks than maybe like an apartment complex. Is
Yeah,
that true?
yeah,
And if
because
so,
yeah.
why?
Yeah, it's a great question. The answer is yes, it is true, and because the majority of the improvements inside a mobile home community, again, forget the homes, right? But like just the mobile home park itself, most mobile home parks don't have a lot of underlying land value, right? Like they're kind of in like the outskirts of town, like they're not like in
Mhm.
downtown areas or prime locations most of the time, and so most of the value is associated with the infrastructure, which all falls underneath that 15-year or
Mhm.
less depreciation schedule. And
Wow.
so, yeah. So it's huge. I mean, I'd say on average, we go to we get cost like studies done on all the parks we buy, and on average, it's anywhere between like 75% of the overall purchase price that we get
So
to.
that so
Not
that's
right.
even
We don't know if 100% bonus appreciation comes back, but like in the heyday, you would write off literally 75% of the entire purchase price year one. Now
which
it's
is
scaled down
excellent.
to 80, but it might come
That
back.
was that was one of the things that got me interested most. I was like, because there was a point where I, when I found out about depreciation, I was like, oh man, like I've been investing in real estate the completely wrong way. Like I've only been looking at cash flow. Now I started looking at cash flow and the
Oh yeah, it's
depreciation as well
huge.
too, which that helped me out tremendously in terms of taxes. So, um,
I truly think outside of like the only other asset class that I've seen be more tax efficient is our car washes because of the equipment factor, and that's assuming that they're not like on the main best location on the corner where the underlying land value is substantial. But like car washes are incredibly tax efficient as well. But outside from that, I mean, mobile home parks, I have not seen another asset type of the standard asset types, right, that we all know of: self storage, multifamily, industrial, office retail. Nothing comes close to mobile home parks. RV parks would a lot of times fall in that same category as well.
yeah. Let's say that somebody like wanted to invest with you, because like a lot of people may watch this episode and be like, "Oh, that all sounds great," but like there's a learning curve attached to it, and they may be like, "It's simpler to invest with you." If they wanted to, what does that look like? How can people get a hold of you? And then also, any final words as well too.
Yeah. I mean, if you want to learn about who we are and what we do and our current offerings, you can go over to investwithsunrise.com. And on our website, we've got details on all like historical deals we've done. We've got a lot of information that we kind of put up there for people to look at. We even put up appraisal, like any deal we currently own today. We put up appraisals. We put up like the underwriting, our business plan, deals we've gone full cycle on. We have kind of case studies drawn out on them, just so you can understand who we are and what we do and what our specialty is. We do have a fund that we just opened. It's our fourth fund. We just launched it November of 23. It's currently got 2 assets in it. We've got another 5 parks under contract in different stages of the pipeline. It's a $100 million fund. We currently have about 25 million of it deployed into the first 2 assets, and intend to have it hopefully filled up by the end of this year. But it's for accredited investors only, so you got to meet that accreditation status. Minimum investment's 100K, and then we got 3 different classes, basically 8, 9, or 10 pref. 8 pref for those that invest between 100 to 249,000. A 9 pref for those that invest 250 to 499, and then a 10 pref for those that invest 500,000 or greater. It's a 70-30 split. We don't participate until we get a full return of capital back to the LPs, to the investors. And outside of that, there's a 2.5% acquisition fee, 1% asset management fee, and I think that's all the primary metrics of it. It's pretty straightforward. It's a pretty, I mean,
Yeah.
we keep things kind of like keep it simple, stupid, keep it really easy to understand. We don't put a bunch of different waterfalls or anything like that in there. Just, we look to get a return of capital back as soon as possible. Historically, our first fund, we got a full return of capital in like 2.5 years. We still own a number of assets in that first fund that our investors still have ownership in. Second fund, we got a full return of capital in just over 3 years. Still own assets in that fund that our investors still, participating, have cash flow and ownership in. Our third fund, which we had open for a couple of years, we stopped taking capital in that one last August. That one's still going through stages of, we were buying properties for about 2.5 years in that fund. Some are fully stabilized. Some are still going through the business plan. We've recapped a few of them, have started on the return of capital process, but it's going to be a number of more years until we can do a full return of capital in that one. And then we'll do the same thing with the fourth fund here that we just launched. So,
Got it. Well, I want to say thank you, Kevin, for taking the time to obviously educate our viewers. To our viewers out there, I want to say thank you as well for taking the time to watch it. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button. Once again, we had Kevin Bupp. The topic was how to invest in mobile home parks. We talk about different locations, underwriting, financing, managing them, leasing the land, depreciation. So this was an all-inclusive video. Thanks again, Kevin, and to our viewers, until next time.